Every time you get paid, you want to have some money consistently, passively, and automatically invested into your portfolio of funds. This way you don't have to worry about it. Set it up whether it's every week, every 2 weeks, every month. Every time you get paid, some money is automatically going to be invested, and then this is going to be working to grow for you, because then when this makes you some money, it can automatically be invested back into your funds. So when you're getting dividends, it can automatically be invested back into your funds, and you don't have to worry about it because now it's consistent, passive, and automatic. You set it once, you find the funds, and then you forget about it because it's passive and it's automatic. And the third part to this is your psychology and how you succeed as an investor. And the best way to take a look at this is just to see an example. Take a look at the stock chart. Back in 2020, when the stock market crashed because of COVID, we saw SPYD, that ETF, fall by almost 50% over the course of a month. Let me emphasize this one more time. We know that market crashes happen. We know that recessions happen. They are a part of our economic system. And what most people do when these things happen is they sell, they panic, they run away. But what you want to be doing if you have a good asset is buy more of that thing when it's on sale. Let me kind of go through this hypothetical. Let's assume that there is a stock or ETF or fund that's trading for $100 a share that's paying out a 5% dividend yield. That is a $5 per share yield a year. And then the markets crash. Now you see this fund trading for $50 a share. Now there's a couple things that could happen. Maybe they don't change their dividends because, yeah, the market's crashing, but this company or fund is still making their profits so they can pay out the same dividends. They're still paying out the $5 a share. Well, what does that mean? Now you can come in and buy this and get a 10% yield because they haven't cut their dividends yet, assuming it's a good fund. Or option number two is maybe they cut their dividends in half as well. So now the dividends go down to $2.50 a share, which is again a 5% yield. But now the interesting thing is, assuming this is a good fund, that's the key here, because if you don't know how to do your research and you invest into something that's really going down, well, that's not good. That's where your financial education comes in, to analyze, understanding the financial trends, knowing how to find a good investment. Well, now, assuming that you can come in and buy here at a discount and then it goes back up, well, now you got to buy a good investment for 50 cents on the dollar. And then if that's the case, your dividends also go up. So now you go from getting $2.50 in dividends to $5 a share in dividends, which means your yield is no longer 5%, it's 10%, because you're getting $5 a share in dividends and you bought your stock for $50 a share. Of course, that's the goal over the long term, because you want to invest in a fund that's growing in value, that's paying out dividends. But if you see these market opportunities, where you see these broad market downturns, they can create opportunities for you to see these rapid run-ups or rapid discounts while most people are running away. That's the psychology of succeeding. And it has to do with you buying a good investment. The mistake that so many people make is they come in and they make their buying decisions based off of this right here. They see what the dividend yield is and they say, "Ooh, that's a high dividend, let me go out and buy that thing." That is a bad way to do that, because, well, this is paying out a 10% dividend, which looks nice, but if this company or fund is on the way to bankruptcy, that's not good. And that's why you really want to understand and analyze the underlying asset. If you find a good underlying asset, you can find a way to make money. If you don't have a good underlying asset, well, now you're just buying a company or fund that is going to be losing your money for the rest of your career, and that's not what I want for you. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.